Welcome, curious minds. Get ready to take a deep dive into the fascinating world of financial markets. Today, we're dissecting a particularly intriguing day, August 15th, 2025. This was a day where the headlines might have told one story, but as we peeled back the layers of data, the underlying picture revealed something far more complex, a real study in market contrasts.
That's exactly right. What we witnessed on that Friday was a truly pronounced display of market divergence. It absolutely underscores why it's so crucial to look beyond the surface, to truly dig into the numbers and understand their nuances, because the headline figures were frankly quite misleading. We've taken a comprehensive market report and are going to pull apart the data, uncover the underlying currents, reveal the unexpected drivers, and explore the critical implications. For investors, obviously, but really for anyone tracking the pulse of the global economy. This isn't about simply rattling off numbers. It's about making sense of the intricate dance between corporate actions, economic signals, and geopolitical shifts.
Our mission today is precisely that. To unpack this intricate report, distilling the most important nuggets of knowledge and insight specifically for you. We'll explore how something as specific as a single corporate action can send ripples, or maybe even tidal waves, through entire market indices. We'll examine how conflicting economic data creates a relentless tug-of-war for central bank policy, leaving investors guessing, really keeps you on your toes. And we'll see what the movements in everything from the price of oil to the stability of gold tell us about the broader macroeconomic landscape. By the end of this deep dive, you'll walk away with a nuanced, data-driven understanding of a day where the market was anything but monolithic and why that matters. The global market stage. Setting the scene for divergence. Let's start by painting the global picture for August 15th, 2025. What was the overall vibe on a Friday that would become so noteworthy? And, what unique global factors were quietly, or maybe not so quietly, at play that shaped the trading day?
Well, the executive summary of our report immediately flags this day as one characterized by a pronounced display of divergence.
Hmm.
And that phrase, to anyone familiar with markets, is an immediate signal. It tells you this wasn't a day where all assets were moving in unison, where a rising tide lifted all boats or a falling tide pulled them down together. Not at all. Instead, we saw significant parts of the market pulling in entirely different directions. On the surface, the Dow Jones Industrial Average hit a new all-time high, which naturally sounds like a broad surge of strength and optimism, right?
Right, sounds great on paper.
But here's the crucial counterpoint. Both the S&P 500 and the NASDAQ Composite, which are far broader and frankly more representative measures of overall market health, actually finished the day in negative territory.
Okay. So not so rosy overall then.
Exactly. This immediate stark contrast is absolutely key to understanding the day. It signals unequivocally that market sentiment wasn't uniform. The report describes it as highly selective and news-driven, creating what it aptly calls a stark bifurcation. This wasn't just a minor difference in performance between indices, it was a fundamental split. It shows investors were reacting to very specific, impactful pieces of information rather than any sweeping, broad market trend. It forces you to ask, why did some parts of the market soar while others stumbled? What were the particular catalysts strong enough to create such a divide? And as we drill into the data, you'll see some fascinating, sometimes counterintuitive answers emerge.
You touched on global factors, and I noticed something in our sources about India having a holiday that day. It seems like a distant event, maybe, but how did that seemingly minor detail impact what happened here in the U.S. markets?
That's a great observation, and it highlights just how interconnected global finance truly is, even in subtle ways. On August 15th, India observed its 78th Independence Day. This meant that all major financial markets across India, the BSE, NSE, MCX, NCDEX, were completely closed for trading.
Okay, completely shut down.
Exactly. And while it might seem like a small detail, its implications for global trading were quite significant. The closure of one of the world's largest and fastest-growing emerging markets had a measurable effect on overall global trading volumes. They were notably lighter than usual, and this reduced liquidity can sometimes amplify price movements. More importantly, the usual torrent of international market-moving news and data flows from Asian markets was significantly reduced. This created a kind of relative vacuum, as the report puts it.
The vacuum.
Yeah, where the focus of global investors narrowed dramatically. Without competing narratives from the bustling markets of Mumbai or other Asian hubs, the developments from the active U.S. and European sessions suddenly took center stage, and their importance was amplified. It's almost as if the U.S. market, for a day, had a less cluttered stage to perform on.
So the US-centric news had less competition for attention, almost like it had the spotlight all to itself, making its impact potentially larger than it might have been otherwise.
Precisely. With fewer distractions or counter-narratives emanating from other major global centers, U.S.-centric news, especially significant corporate disclosures, like the one we'll definitely discuss from Berkshire Hathaway, and the various domestic economic data releases, became the primary focal points for international investors. This concentrated attention meant that any major U.S. news had its immediate impact on sentiment and asset prices potentially magnified. It's a classic case of supply and demand for information. When the supply of global market-moving news is reduced, the demand for an impact of available news naturally increases.
Makes sense.
Interestingly, European markets also exhibited mixed performance that day. They were largely awaiting the outcome of a high-stakes meeting between U.S. President Trump and Russian President Vladimir Putin. This summit also contributed to the concentration of attention on singular, potentially impactful events rather than broad-based economic trends. The market was kind of holding its breath, anticipating the next big piece of news. And for that particular Friday, much of that anticipation was directed squarely at developments unfolding in Washington and the possibility of a geopolitical shift. This unique confluence of factors truly put the domestic U.S. session at the undisputed center of global market activity for that day, making its individual data points all the more critical to dissect. 2. The U.S. indices, a tale of two markets.
Okay, let's really unpack this divergence in the U.S. markets because it's absolutely central to understanding the day. The report uses a striking phrase: Dow's record ascent masked broader market hesitation. That sounds like a big red flag for anyone just looking at the headlines, maybe checking their financial apps on their phone.
It absolutely is a red flag, and this section is vital for truly understanding the nuances of how major indices work, and why simply glancing at the headline number can be profoundly misleading. Let's look at the actual closing data for these major U.S. indices on August 15, 2025, and you'll see the story unfold.
Okay, lay out the numbers for us.
Right. The Dow Jones Industrial Average, our venerable U.S. 30, closed at 45,056.82 points. That was up a respectable 144.82 points, a gain of 0.32%. That's the headline number that screamed new all-time high.
The one everyone saw.
Exactly. But then we look at the S&P 500, a much broader representation of the U.S. equity market. It's finished at 6,457.90, actually down 10.64 points, or minus 0.16%.
Down 0.16.
The tech-heavy NASDAQ composite closed at 21,710.67, barely budging, down a tiny 2.47 points, or minus 0.01%, basically flat.
Flat.
And perhaps most tellingly for broader economic health, the Russell 2000, which tracks smaller U.S. companies, the U.S. 2000. It closed at 2,288.55, down a more significant 10.53 points, or minus 0.46%.
Okay, so the smaller companies were definitely feeling some pressure.
Definitely. Now, for the core analysis, the Dow's new all-time high was astonishingly narrow in its composition. The report makes it clear that it was almost entirely attributable to a single catalyst, a massive surge in shares of United Health Group.
Just one stock.
Pretty much. This is where the mechanics of the Dow become so revealing. United Health Group, ticker UNH, soared more than 12% on the day. Huge jump. This monumental gain occurred after Warren Buffett's Berkshire Hathaway disclosed a significant investment in the company. That sent a powerful signal to the market.
The Buffett effect.
Exactly. But why did one stock have such an outsized impact on the Dow? It highlights a crucial structural characteristic of this particular index. Unlike the S&P 500 or NASDAQ, which are market capitalization weighted, meaning larger companies have a greater influence based on their total value,
Right.
The Dow is a price-weighted index.
Price-weighted. Remind us what that means exactly.
Sure. Think of it this way. In the Dow, a stock's actual share price dictates its influence on the index's movement, not its total market value. So a high-priced stock like United Health Group, which was trading, north of $300 a share, when it sees a double-digit percentage gain, it disproportionately pulls the entire 30-stock average higher.
Ah, okay. So its high price gives it more weight, regardless of the company's overall size compared to others in the Dow?
Precisely. That single powerful move in UNH alone lifted the entire average into record territory. It effectively masked weakness or tepid performance among many of its other constituents. So relying solely on the Dow as a market barometer on this day would have been highly misleading. It wasn't a reflection of broad economic optimism or widespread corporate health. It was, as the report puts it, an artifact of its specific construction. It's a classic example of how one powerful data point can completely distort the overall perception if you don't dig deeper.
That makes perfect sense. So If the Dow was largely an anomaly, being pulled up by one really big stock and its unique weighting mechanism,
Yeah.
what was truly happening in the broader market, especially with the S&P 500 and Nasdaq, which reflect a much wider slice of the economy?
Well, the S&P 500 and Nasdaq finished with those modest losses we mentioned. Essentially, they were taking a bit of a breather after what had been a rather strong week for both indices. Their overall weakness stemmed from two primary factors, both providing important insights into underlying market anxieties.
First,
First, we observed significant sector-specific headwinds. The influential semiconductor industry, a real bellwether for technology and global economic health, faced a sharp downturn. A key player in that space, Applied Materials, or AMAT, issued what was described as cautious forward guidance. They specifically cited increased uncertainty in their crucial China business, a concern that has been simmering for some time due to trade tensions and geopolitical maneuvering. This news weighed heavily on the tech-heavy Nasdaq and, by extension, the S&P 500's information technology sector, as investors pulled back from an area seen as vulnerable.
so bad news from one big chip company spooked the whole sector.
Pretty much. And second, beyond the specific tech sector issues, there was a palpable sense of broader market caution and profit-taking. After what had been a record-setting week in some parts of the market, investors simply appeared hesitant to increase their risk exposure, especially heading into a weekend laden with geopolitical uncertainty, that Trump-Putin meeting looming, and those conflicting economic signals we're about to discuss.
Right, uncertainty tends to make people cautious.
Exactly. And this was particularly true given the steady rise in bond yields, which often make equity investments less attractive as bonds offer a higher, relatively safer return. This cautious sentiment was also clearly reflected in the performance of the Russell 2000 index, tracking small-cap companies, as it fell that notable 0.46%. Small-cap companies are inherently more sensitive to changes in interest rates and broader economic conditions. They usually have higher borrowing costs and are more domestically focused. This makes them particularly vulnerable to renewed inflation concerns, like the ones that emerged from the previous day's economic data. It suggested a more challenging environment for smaller businesses to thrive. So while the Dow soared, the broader market was telling a much more nuanced story of selective risk-off sentiment. 3. The economic tug-of-war, consumer resilience versus inflationary ghosts.
This sounds like the market was receiving genuinely mixed signals from the economy itself. It's fascinating. On one hand, we have this picture of surprisingly resilient consumers still spending, but on the other, these lingering, even rekindled inflation concerns. Let's really dive into the data here that created this push and pull, almost a tug of war for the Federal Reserve's future policy.
Absolutely. This dynamic created a clear and difficult push and pull on Federal Reserve policy expectations. It made their next move incredibly hard to predict and, consequently, kept the entire market on edge. Let's look at the specifics of each side of that tug-of-war.
Okay, let's start with the consumer side. The positive side, maybe.
Right. On the side of the resilient consumer, the primary economic release of the day was the July retail sales report. It showed that sales rose by 0.5% for the month. Now, that figure landed exactly in line with consensus analyst expectations.
So, right on target. Not bad, not amazing.
On the surface, yes. An inline number might seem neutral, but the underlying details painted an even stronger picture of consumer health. Crucially, the sales figure for June was actually revised significantly higher. It went from an initial 0.6% increase to a much more robust 0.9% gain.
Oh, wow, that's a big revision upwards.
It is. This upward revision meant that consumer momentum heading into the third quarter was more robust than previously understood.
Yeah.
The economy wasn't just holding steady, it was actually gaining more steam than initially reported. Furthermore, if we dig deeper, the control group for retail sales. This is a key indicator because it excludes volatile components like autos, gasoline, and building materials, making it a direct input for GDP calculation. It also climbed a solid 0.5%.
Okay, so broad strength then.
Yes, it confirmed broad-based strength in consumer activity. It indicated people were spending across various categories, not just on necessities. We saw notable jumps in sales at motor vehicle dealers and furniture stores. That shows a surprising degree of consumer willingness to spend on discretionary items, even in an environment of higher interest rates. This data clearly signaled that the U.S. consumer, the engine of the economy, was far from slowing down.
So robust consumer spending is good news, right? But then we have the other side of the coin, as you said. Tell us about the PPI hangover and what made it such a significant inflationary shock.
Precisely. While the retail sales data was certainly constructive for the growth outlook, the market was still heavily processing the implications of the July Producer Price Index, or PPI data. That had been released just the day before. And this, the report emphasizes, was indeed a significant inflationary shock that completely shifted the inflation narrative.
A shock. What were the numbers?
The numbers were quite stark. The PPI showed a month-over-month increase of 0.9%. To put that in perspective, that dramatically exceeded the modest 0.2% forecast, zero point 0.9 versus zero point 0.2 expected, and it marked the largest such jump since June 2022.
Wow, that's a big miss, and the biggest jump in years.
Exactly. On a year-over-year basis, the headline PPI rose 3.3%, reaching its highest annual increase since February. This wasn't just a blip, it was a clear re-acceleration of inflationary pressures at the producer level.
And what was the market impact?
Immediate and significant, across multiple asset classes. It reignited serious concerns about entrenched inflationary pressures. It effectively challenged the prevailing narrative that inflation was steadily and smoothly returning to the Federal Reserve's 2% target. You know, when producers face higher costs, those often get passed on to consumers down the line, pushing up the CPI. The bond market reacted particularly sharply to this news. Treasury yields rose significantly across the curve, with the benchmark 10-year yield climbing. Investors demanded greater compensation for the increased inflation risk they now perceived. Essentially, if their future returns on bonds are going to be eaten away by inflation, they need a higher upfront yield to make it worthwhile.
Makes sense. Higher risk, higher required return.
Right. And analysts from Goldman Sachs, as noted in the report, put it quite succinctly. They observed that such data contributes to an unfriendly asymmetry in the market.
Unfriendly asymmetry. What does that mean?
What they mean by that is the combination of already high valuations in the stock market coupled with resurgent inflation. It significantly elevates the probability of a significant drawdown, a substantial drop in asset prices, even in what might otherwise seem like a calm, low-volatility environment. It's a very pointed warning about the fragility of the current market state, where positive economic news, if it fuels inflation, can suddenly turn negative for equities because of what it implies for Fed policy.
So the Fed is really caught between a surprisingly strong economy, as evidenced by that resilient consumer spending, and persistent, even resurgent inflation coming from producers. What does this complicated, almost contradictory data mean for their next move, and how is the market interpreting it?
It presents a very clear and difficult dilemma for the Federal Reserve. They have that dual mandate: maximum employment and price stability. On one hand, robust consumer spending, bolstered by those upward revisions, suggests that the economy is strong enough to withstand the current level of interest rates. If the economy is clearly holding up well, why cut rates immediately?
Right, less urgency.
Exactly. This reduces any immediate urgency for the Fed to ease monetary policy, removing one pillar of support for market hopes. But simultaneously, that hot PPI reading we just discussed strongly suggests that cutting rates prematurely risks embedding higher inflation into the economy. That would make it much harder to control down the line. The last thing the Fed wants is to see inflation become entrenched or, worse, have to reverse course with aggressive hikes later.
A real tightrope walk.
Absolutely. This dynamic has led to the reemergence of a paradigm that market watchers know well: the good news is bad news scenario for equity markets.
Explain that again.
What that means is strong economic data, while fundamentally good for corporate earnings and overall economic health, is actually perceived negatively by the market in this specific context. This is because it's seen as giving the Fed justification to either delay or reduce the magnitude of anticipated rate cuts. And these anticipated rate cuts have been a key pillar supporting equity valuations for some time now. So a strong consumer implies less need for cuts, which, paradoxically, hurts the market's hopes for lower borrowing costs and higher valuations.
Good news for the economy is bad news for rate cut hopes, which is bad news for stocks.
Got it.
You got it. Despite this tension, futures markets, specifically looking at the CME FedWatch tool, still priced in what seems like a very high probability. 93% odds of at least a 25 basis point rate cut at the Fed's September meeting.
Yeah.
So the market desperately wants those cuts, clinging to the expectation.
93% seems pretty certain. It does, but here's a critical nuance. The inflation data we just reviewed, that PPI shock, it, quote, effectively removed any lingering possibility of a more aggressive 50 basis point cut from consideration.
Yeah.
Before the PPI report, there might have been a slim chance, some speculation, about a larger, more impactful cut, but that's now completely off the table. The market is thus left in suspense. It's still pricing in some degree of easing, but the economic data, particularly the stubborn inflation numbers, increasingly complicates the central bank's path forward and adds a significant layer of uncertainty to investor expectations. It's a delicate balancing act, And every new piece of economic data only makes the tightrope walk more precarious.
Uh-huh.
Sector deep dive, winners and losers.
Okay, moving from the big picture of the indices and economic data to specific sectors, it sounds like there was a major reshuffling of fortunes on August 15th. Who were the standout winners and losers on this day, and what specifically drove their performance?
Indeed, we saw a sharp sectoral rotation that truly reflected the divergent market conditions.
Hmm.
When you look at the S&P 500 sector performance, the picture becomes incredibly clear. It illustrates the selective nature of the market's movements.
Give us some examples.
Sure. For instance, healthcare, represented by the XLV ETF, was up a remarkable 3.35%. Huge day. Financials, XLF, also saw a positive day, gaining 1.03%. But on the flip side, information technology, XLK, was down a notable 1.0%. And energy, XLE, was the biggest laggard, dropping 1.52%. This kind of divergence among sectors is a powerful indicator that capital is flowing very specifically, moving out of some areas and into others based on the day's catalysts.
So healthcare was the big winner. What was behind that?
Right, diving into this sector winner, healthcare truly had a banner day and was the undisputed leader.
Hmm.
Its impressive performance was almost entirely buoyed by that more than 12% surge in United Health Group, or UNH. As we discussed, UNH is not just a component of the Dow, but also one of the healthcare sector's largest components by market cap within the S&P 500. So this powerful move in UNH had a significant positive ripple effect across the entire managed care industry.
Others in the industry benefited too.
Yes, we saw other major health insurers like Centene, CNC, Molina Healthcare, MOH, and Elevance Health, ELV, all gaining significantly, roughly 4% to 5% on the day, riding the wave of positive sentiment that UNH created.
Interesting. Why such a strong reaction? Was it just Buffett?
Well, the analysis suggests this rally could be interpreted as a classic mean reversion trade.
Mean reversion.
Yeah, basically bouncing back after being down for a while. To put that into context, healthcare had actually been the worst performing S&P 500 sector year-to-date through July. United Health Group itself ranked among the index's biggest individual losers over that period. The sector had been heavily weighed down by a confluence of concerns: rising medical costs, various regulatory pressures, disappointing earnings guidance from some companies earlier in the year. It was, in many ways, an oversold and out-of-favor segment.
So, ripe for a rebound if good news hit.
Exactly. The substantial positive catalyst provided by the Warren Buffett endorsement, therefore, appears to have triggered a sharp relief rally. It signaled to the market that there might be deep value in this previously neglected segment. It was a classic example of a single, powerful piece of news shifting perception and driving a dramatic rebound in an area that had been beaten down.
That's a really clear example of how sentiment can drive a sector. And on the flip side, information technology took a significant hit, especially the semiconductor companies. What was driving that downturn, particularly for such an influential part of the market?
Precisely. Information technology was, in stark contrast to healthcare, a primary source of weakness for both the S&P 500 and the Nasdaq. The epicenter of this downturn, as the report describes it, was specifically the semiconductor subsector, and it faced a confluence of negative catalysts. The semiconductor industry is particularly influential because it's foundational to so many other technologies, from smartphones to AI. Its performance is often seen as a bellwether for the broader tech economy.
Right, very important sector. What was the trigger?
The primary driver here was the market's harsh reaction to the quarterly report from Applied Materials, AMAT. While the company's earnings per share actually exceeded expectations, its revenue missed. And, more critically for investor sentiment, its forward guidance for the upcoming quarter fell significantly short of analyst projections.
The guidance. That's often key.
Absolutely. The why behind this was explicitly detailed by the company's management. They cited a dynamic macroeconomic and policy environment and increased uncertainty, particularly concerning its China business, as the reasons for its cautious outlook. This warning from a key industry bellwether like Applied Materials, which supplies equipment to chip manufacturers worldwide, had a direct contagion effect.
Contagion, meaning it spread.
Yeah, it spread negativity to other companies in the sector. We saw it immediately drag down peers such as KLA Corp, KLAC, and Lam Research, LRCX. They fell 8% and 7% respectively, basically in sympathy with AMAT's decline. When a leader in the space issues a warning like that, the entire industry listens and investors react.
And were there other factors hitting semis?
Yes. Compounding these corporate-specific factors were broader geopolitical concerns that have been hovering over the semiconductor industry for some time. President Trump had signaled the possibility of imposing steep tariffs on imported semiconductor chips. This rhetoric, combined with the U.S. government's ongoing efforts to limit China's access to advanced chip technology, created an environment of significant uncertainty. This geopolitical tension further soured sentiment on this particular industry. It's highly capital-intensive, requires complex global supply chains, and is deeply interconnected across international borders. Any threat of tariffs or trade restrictions can severely disrupt their business models and profit margins. So you had a powerful combination of specific company guidance and overarching political rhetoric, creating a very challenging environment for the entire sector on that day. Corporate narratives and market movers. The power of specific stories.
It really seems like individual company news, or what we might call corporate narratives, had a massive outsized impact on August 15th. Perhaps even more so than broader macroeconomic trends for specific stocks on that particular day. What were the most significant corporate stories driving the market?
You're spot on. The day was ultimately defined by a handful of powerful company-specific stories, as the report emphasizes. These weren't just isolated events. They had significant ripple effects across their respective industries and even the broader market indices. It proves that sometimes the micro truly dominates the macro, at least for a day. Let's look at some of the most notable movers from our sources. The data points really jump out.
Okay, let's see the highlights.
Well, we had United Health Group, UNH, up that whopping 12.33%, driven by the Berkshire Hathaway investment we've been discussing. Applied Materials, ANAT, plunged 13.87% due to its weak forward guidance and China uncertainty. Ouch. Interestingly, Intel Corp, INTC, jumped 3.06% on reports of a potential U.S. government investment stake, a bright spot in a dim sector. And then there's Sunrun, RUN, which just skyrocketed 36.15% in a broader rally across solar stocks. Huge move there.
Wow, 36%.
Yeah, these are just a few examples, but they vividly illustrate the concentrated and often contradictory nature of the day's market activity. The most significant market-moving event was, without a doubt, the release of Berkshire Hathaway's latest 13F filing.
Right, the Buffett news again. Remind us what a 13F is.
Sure. For those unfamiliar, a 13F filing is basically how we peek into what the market's biggest institutional players, like Warren Buffett's Berkshire Hathaway, are buying and selling. The quarterly report they have to file with the SEC, detailing their public equity holdings. When it drops, everyone pays attention because these are often long-term, high-conviction investments. The disclosure of a massive new stake in United Health Group was the primary catalyst for the stock's remarkable 12.3% surge, and by extension, as we discussed, the Dow's record-setting performance. The Buffett effect, the well-documented tendency for a stock to rally after the highly respected investor Warren Buffett or his firm discloses a position, was on full display. It showcased his immense signaling power. His stamp of approval can fundamentally shift how the market views a company or sector.
And it wasn't just UNH that got a boost from that filing, right?
That's right. This positive sentiment wasn't confined to just United Health Group. The filing also revealed new investments in major home builders, Lennar, LNN, and D.R. Horton, DHI. They both rose approximately 3%. And it also showed a new stake in steel producer Nucor, NUE, which gained a healthy 6% on the news. This series of rallies across multiple, seemingly disparate sectors, healthcare, housing, industrials, underscores the immense signaling power that influential investors can wield. Simply by disclosing their positions, they can change market perceptions, spark investor interest, and drive significant capital flows. It's a powerful demonstration of how confidence from a legendary investor can act as a potent catalyst for a stock.
So we have the Buffett effect, lifting healthcare and some other sectors. But on the flip side, what about Applied Materials? Its plunge sounds like a powerful counter-narrative to that optimism.
Indeed. On the starkly negative side of the corporate narrative, semiconductor equipment manufacturer Applied Materials, AMAT, saw its shares plunge nearly 14%. While the company's quarterly earnings per share actually exceeded expectations, it missed on revenue projections. But more critically, the forward guidance provided by management for the next quarter fell significantly short of analyst projections. That's often the killer.
The guidance again. Why the weak outlook?
The why behind this was explicitly detailed by the company. Management cited a dynamic macroeconomic and policy environment and increased uncertainty, particularly concerning its business in China, as the reasons for its cautious outlook. This warning from a key industry bellwether, like Applied Materials, a company whose equipment is essential for producing nearly all advanced chips, had that direct contagion effect we talked about, spreading negativity. We saw it immediately drag down peers like KLA Corp and Lam Research by 8% and 7% respectively. It's a powerful reminder of how one company's guidance, especially a leader in a crucial supply chain, can dictate the sentiment for an entire industry. particularly when coupled with those broader geopolitical anxieties around trade and technology.
So, a tough day for most of the semiconductor sector, but Intel seemed to be an island of green, rising over 3% against that very challenging backdrop. What was their unique catalyst that allowed them to defy the trend?
That's a remarkable counter-trend move indeed. Intel, or INTC, stood out as a beacon of strength within the otherwise battered semiconductor sector, jumping over 3% during the session. Now, this divergence wasn't driven by company fundamentals or earnings, which is key. Not fundamentals, what then? Instead, it was driven by a specific geopolitical and industrial policy development. Reports emerged that the U.S. administration was in discussions with Intel about the government potentially taking a direct equity stake in the company.
The government buying Intel stock.
Potentially, yes. This potential move, which could likely be funded through the CHIPS Act, is explicitly aimed at bolstering domestic chip manufacturing and reducing reliance on foreign supply chains, particularly from Asia. The CHIPS Act itself is that landmark piece of legislation designed to incentivize semiconductor manufacturing and research here in the U.S. This news allowed Intel to trade on its own unique catalyst, effectively insulating it from the broader industry sell-off. It highlights how government policy and strategic national interest can create idiosyncratic winners even within a challenged sector. It demonstrates that not all industry trends are uniform, and individual stories can truly break away from broader headwinds.
Fascinating. Any other notable movers that day?
Yeah, beyond these major players, there were other notable movers. Retailer Target, TGT, saw its shares fall 1.7% after receiving a downgrade to underperform from Bank of America. The bank's analysts cited very challenged digital trends for the company, indicating specific business headwinds, despite the broader consumer resilience we discussed earlier. This underscores that even with a strong consumer, individual company execution and specific competitive pressures can lead to underperformance.
So even strong overall spending doesn't lift all retail boats.
Exactly. And then there was notable activity in the so-called meme stock space. Open Door Technologies, Open, was among the most actively traded stocks, with its shares rising nearly 7% on news of a CEO transition. This shows that even on a day dominated by large corporate news and macro data, speculative retail interest, often amplified by social media, can still generate significant, often volatile, movements in specific names, creating their own distinct narratives. 6. Commodities, currencies, and bonds. Reading the broader macro tea leaves,
Okay, beyond individual stocks and sectors, what were the other big asset classes, commodities, currencies, and bonds telling us? What were they signaling about the broader macroeconomic forces at play on August 15th? This is where we often find the deeper signals for the economy and how global events are truly being interpreted, right?
this is precisely where we can see the complex interplay between inflation expectations, the global growth outlook, and geopolitical risk. These asset classes often serve as leading indicators or reflections of broader market sentiment that might not be immediately obvious just from stock market headlines. Let's look at the key data from our asset class dashboard because they often tell a story that complements and sometimes contradicts the equity market.
Lay it out for us. What were the key moves?
Okay. West Texas Intermediate, WTI crude oil, for the September contract settled at $62.80 per barrel. That was down $1.16, a 1.81% drop. The benchmark 10-year U.S. Treasury yield rose to 4.33%. That's up 0.04 percentage points, or about 0.93%. The U.S. dollar index, the DXY, which measures the greenback against a basket of 6 major currencies, actually declined by 0.40 points, or 0.41% to 97.85. And gold futures, spot equivalent, finished relatively unchanged at around $3,380 per ounce. Pretty steady. Each of these tells a distinct part of the macro story for that day. Okay, let's start with energy. Crude oil falling almost 2%. What was driving that? Right, for energy. WTI crude oil prices continued their downward trajectory, suggesting a significant shift in market perception. The primary driver of Friday's weakness, as highlighted in the report, was investor positioning ahead of the weekend meeting between U.S. President Trump and Russian President Vladimir Putin.
Ah, the summit again. Hopes for de-escalation.
Exactly. There were increasing hopes for a potential de-escalation of the conflict in Ukraine. Such a de-escalation, if it resulted from these high-stakes talks, would lead to a significant reduction in the geopolitical risk premium that had been embedded in oil prices. Essentially, when there's conflict or heightened political tension in major oil-producing regions, traders factor in a premium for supply disruption risk. Less conflict, less risk, lower oil prices. There was the market's expectation leading into the weekend, indicating a more optimistic geopolitical outlook, at least temporarily.
Okay. And in the fixed income market, we saw Treasury yields continue to climb. That seems like a direct response to those inflation numbers we discussed earlier, doesn't it?
That's exactly right. In the fixed income market, the benchmark 10-year Treasury yield continued its ascent, rising to 4.33%. This move higher was a direct and continued reaction to Thursday's surprisingly hot Producer Price Index, the PPI report that we discussed. Bond investors facing clear evidence of resurgent inflation are demanding higher yields as compensation for the potential erosion of their future returns due to rising prices. If inflation is ticking up, the real return on a bond diminishes, so investors need a higher nominal yield to maintain their purchasing power. This rise in yields fundamentally reflects a repricing of inflation risk and, importantly, a slight paring back of expectations for immediate and aggressive Federal Reserve rate cuts. If inflation is sticky, bond investors need to be paid more to hold that debt, and they anticipate the Fed won't cut rates as quickly as some initially hoped. This has broad implications across the economy, impacting everything from mortgage rates to corporate borrowing costs.
Right. Now, the dollar weakening, that seems odd with higher yields. Usually higher yields attract foreign capital and strengthen the currency. No.
Exactly. Turning to foreign exchange, the U.S. dollar index, DXY, declined by approximately 0.41% to 97.85. This move presents a seeming contradiction, as the report points out, because the currency typically strengthens alongside rising domestic bond yields. You would usually expect a stronger dollar when U.S. Treasury yields are going up, as it makes dollar-denominated assets more attractive to international investors seeking higher returns. So the dollar's weakness here definitely warrants a closer look.
What could explain that contradiction?
Well, this dollar weakness in the face of higher U.S. yields could be attributed to several factors. It might reflect something as simple as pre-weekend position squaring, where traders adjust their holdings before a potentially volatile weekend, particularly given that Trump-Putin meeting. Or it could be a flight to other perceived safe havens, maybe the Japanese yen or Swiss franc, ahead of that geopolitical summit. Investors might be uncertain about the dollar's immediate outlook given global tensions. Alternatively, and this is more complex and potentially concerning market interpretation, it could signal a fear that if faced with stagflationary pressures, that is, slowing growth, combined with high persistent inflation, the Federal Reserve might ultimately be forced to prioritize supporting economic growth over aggressively fighting inflation.
Meaning they might tolerate more inflation to avoid a recession.
Potentially. And such a policy choice, prioritizing growth at the expense of inflation control, could lead to longer-term currency debasement. That would make investors less keen to hold dollars if they think its purchasing power will erode over time. So it's a subtle but important signal from the currency market. Okay, complex dynamics there. And finally, gold held steady. What does that tell us?
Yeah, finally, let's look at precious metals. Gold futures ended the session relatively unchanged, holding steady near that $3,380 per ounce level. The precious metal showed remarkable resilience, particularly given that it had clawed back some ground after displaying weakness earlier in the week. That earlier weakness was in response to the stronger dollar and rising yields. Normally, gold, which doesn't pay interest and has a carrying cost, becomes less attractive when bond yields rise. The opportunity cost of holding it increases. You could be earning more yield elsewhere relatively safely.
So the fact it didn't fall despite higher yields is significant. It suggests strong underlying demand, yes. This demand likely stems from investors seeking a reliable hedge. A hedge against both the renewed inflation concerns highlighted by that PPI data and the geopolitical uncertainties surrounding the upcoming Trump-Putin meeting. Gold is often seen as a traditional safe haven asset in times of economic uncertainty and geopolitical instability. Its steady performance on this day, despite those headwinds, certainly supports that role. It indicates a degree of underlying anxiety and a desire for portfolio protection among some investors. 7. Concluding analysis and forward outlook.
So August 15th was clearly a day where the headlines, especially that Dow record, masked a much more fragmented and complex market reality. What are the big takeaways from this deep dive? And perhaps more importantly, what should we be watching as we move forward into the next trading week and beyond?
That's the crucial question, isn't it? The market activity of August 15, 2025 served as a powerful reminder that headline index performance can often conceal a more complex and fractured reality. This day was not about broad market conviction or a uniform trend, not at all. Instead, it was characterized by sharp, localized reactions to specific catalysts. The market, as a monolithic entity, didn't move in one singular direction. Rather, distinct pockets of the market moved dramatically in opposite directions, driven by highly idiosyncratic news flow. The Dow's record-setting performance, for example, was a testament to the concentrated power of one influential investor's disclosure, almost an artifact of its construction, as we said. While the Nasdaq's stumble was a cautionary tale about a sector's vulnerability to a single influential company's cautious guidance amidst broader geopolitical tensions. It's a fundamental lesson in understanding market mechanics and the data-driven drivers of asset prices. You have to look under the hood.
That makes the task for investors even more challenging, requiring a deeper look than just the top-line numbers. So what are the key tensions that will really shape the market moving forward from this highly divergent day? What should our listeners be keeping a close eye on?
The report highlights several critical questions that will undoubtedly influence market dynamics and investor decision-making. First, there's the ongoing tension between micro versus macro.
Company news versus the big picture.
Exactly. The foremost question is whether the market will continue to be a stock picker's market, largely driven by powerful company-specific stories like the remarkable surge in United Health Group or the significant plunge in Applied Materials. In a stock picker's market, individual company fundamentals and unique catalysts matter far more than broad economic trends. Or will the overarching macroeconomic narrative of inflation and Federal Reserve policy reassert its dominance? Will it begin to drive broader, more correlated moves across all asset classes where nearly all stocks move together based on interest rate expectations or inflation fears? That dynamic shifts frequently, and August 15th heavily favored the micro, but the macro undercurrents are still very powerful.
Okay, micro versus macro. What's next?
Second, we're watching the question of leadership and sector rotation. Today's powerful surge in the deeply undervalued healthcare sector raises a significant question. Was this merely a one-day relief rally, a short-term rebound for an oversold segment? Or it could be the start of a more durable rotation out of high-valuation growth sectors like technology and into overlooked value plays?
A real shift in what's leading the market.
Potentially. A durable rotation would mean a sustained shift in capital from one part of the market to another, fundamentally altering market leadership. The performance of the semiconductor industry will be a critical bellwether for broader tech sentiment. It'll provide crucial clues on whether growth stocks can regain their footing, or if the market is indeed seeking new leaders in places like healthcare or financials.
Got it. Sector rotation is key. What else?
Third, we have the persistent influence of geopolitical catalysts. The most immediate factor from Monday's market open, and certainly for the days following, will be the outcome of the Trump-Putin meeting. Any definitive news, whether it's positive or negative, regarding the conflict in Ukraine or broader geopolitical stability, could have a significant and immediate impact on a range of assets. Think energy prices, defense stocks, and overall risk sentiment across global markets. Geopolitics has a way of cutting through all other narratives and introducing sudden, unpredictable volatility.
Always a factor to watch. And finally,
the ongoing saga of the consumer versus the Fed. This remains the central conflict for the medium-term outlook. The market has, perhaps optimistically, priced in a certain level of rate cuts from the Federal Reserve. However, as we saw with the July retail sales data, continued U.S. economic strength, combined with the stubborn inflation highlighted by the PPI report, significantly complicates that path for the central bank. This creates a challenging environment for investors trying to anticipate the Fed's next move. Therefore, the next major data point, the Personal Consumption Expenditures, or PCE price index, which is the Fed's preferred inflation gauge due on August 29, will be of paramount importance in resolving this tension. Its numbers could be the deciding factor in how the Fed interprets the current economic landscape and, consequently, how it acts on interest rates. It could potentially determine whether we navigate a soft landing or face more turbulence ahead.
wow, what an incredibly detailed deep dive into a single day of market activity. It truly shows how many layers there are to understand beyond just the closing numbers, and how interconnected everything is. You've given us so much to chew on, from the fascinating mechanics of index weighting to the ripple effects of geopolitical summits and the incredible importance of individual corporate disclosures. This isn't just about data, it's about the intricate narratives those numbers tell.
My pleasure. What's truly fascinating here is how a few key data points in corporate disclosures can combine to create such a complex, almost contradictory market narrative for a single day. It truly emphasizes the importance of understanding the details behind the headlines and how different forces can pull the market in diametrically opposed directions simultaneously. It's a reminder that the market is rarely as simple as it appears on the surface.
And that brings us to our final thought for you to mull over until our next deep dive. If a single investment disclosure from one legendary investor can push an entire major index to a record high, even while the broader market stumbles, What does that imply about the very nature of market efficiency and the profound power of perception versus fundamental economic reality? Think about that and how deeply you'll need to dive into the data yourself until our next deep dive.